to come up as well, and please join the stage. While they're coming up, I can tell you just a little bit of background as me, I guess, about myself. Holden mentioned that, so running AI in BC, so it's the industry body for artificial intelligence. And part of that, I've been in startups and finance for parts of my I guess tech career. This panel's sort of a year in the making because I was at Silicon Valley Bank last year, and you might recall that was a moment that the bank kind of had a bit of a glitch, call it. Basically blew up, and I showed up, last thing I read before getting on the plane was that the regulator had taken over the bank. I'm like, okay, great, just close my laptop and watch the movie then. Arrived, and there was a lot of talk, so it didn't make sense to sort of jump on stage anticipating people asking tons of questions about SVB. So I'm super excited now, a year in the waiting, to come and talk about finance with these very esteemed guests, very knowledgeable folks we have joining us here. So I'll let each of you please introduce yourselves, and maybe just say a little bit about where your focus is investing, and in particular what you do different, whether that's your thesis or something you do that sort of stands out your investing approach or your firm from others in the space.
Thank you.
Is that on? Use this one.
Hi, everyone. How's everybody doing? Everybody awake? Had a little lunch? We're up? Okay, good. So yes, this is a very different vibe than last year. Actually, I do remember last year on Sunday being at a happy hour with a bunch of VCs, and we all had a tequila shot when they announced the bank was getting bailed out. So
yeah,
different vibe. So hi, everyone. My name is Rachel Tenbrink. I'm the general partner of Redbyte Capital. We're an early stage fund based in New York, investing in primarily fintech and SaaS, as well as health and wellness. Just to give you a little background on my journey, I say it's like a 3-tiered cake. So first tier is 15 years as an operator. I was at Estee Lauder, Elizabeth Arden, building billion-dollar brands, Procter & Gamble, et cetera. Second tier, I started a Y Combinator-backed company called Scentbird. We raised around $30 million in venture capital, which makes me one of 90 Latinas that's ever raised over $1 million. Scaled that business. Thank you. It's a big deal. Even more of a big deal is we scaled the business. It's now over 150 million in revenue. As one of 4 founders, I led all of growth. So if you ever want to jam about acquisition, retention, LTV, you name it, I've done it. The other side of it was B2B partnerships and our revenue. So we signed 74 enterprise clients. And then a couple of years ago, sort of the third layer of the cake, and I think the last layer for now, is started to think about impact and what did I want to do. And for me, I love working with early stage founders. I love that point of product market fit and how do you really scale. So started very organically. I was doing a bunch of advisory work. I was in a bunch of advisory boards. That became angel investing, and then we launched the fund about 1.5 years ago. So great to be here.
Hello. Awesome. Hi, guys. My name is Saanya. Super happy to be here. I'm a partner at Bain Capital Ventures, focused on software infrastructure. So anything that a tech buyer will be buying, CTO, CISO, that's DevOps, cybersecurity. It's the tech that tech buys is how we like to talk about it. Before BCV, I used to be at a firm called Co2 for about 4 years, also doing growth stage investing, and had originally started my career at Goldman Sachs, where I used to be a hedge fund analyst, so long, short, fundamental equity. Essentially, just been a student of businesses over the course of my career, and that never gets boring, so fortunate for me. A little bit about Bain Capital Ventures. So we're the ventures arm of Bain Capital, which manages 175 billion in AUM, and that's across a variety of different strategies, from private equity to credit to publics. And as a ventures arm, we are investing in, seed through pre-IPO, high-growth tech companies looking to build the next generational businesses of the future. And to your point of how we do things differently. There is a lot of capital out there in the ecosystem. The way we differentiate ourselves is the common knock against startups is that startups keep in this Silicon Valley bubble. They sell to each other, and it's a house of cards. So what we try to do is branch them out of that bubble they're in and be their first actual enterprise customer on our later stage side. So we'll do kind of customer development work for them because we have very close relationships with key decision makers at JP Morgan and Hitachi and really large corporations. We go and ask them, hey, what are your 5 biggest problems? And then have a day where they meet all of our portfolio companies that are solving those particular problems. So often we're the first enterprise deal that our portfolio companies sign because we're getting them in a room with very late stage corporates that have the problems and they have the solutions. So it's a win-win across the entire ecosystem, and that's what we do differently.
Hi, everyone. My name's Emily Davies, president of Linde Equity. I started my career very different. My current career is very different from these ladies, but also started my career on the other side, which was investment banking, the capital market side, raising capital and advising on mergers and acquisitions for the largest publicly traded companies and some of the largest in Canada, mining and forest products, which are industries we're well known for. 6 years ago, I joined my current business partner, Teal Linde of Linde Equity, and we co-manage the Linde Equity Fund, which is a public equity fund. So that's where the different lens comes from in what I'm doing now. So what we focus on is really identifying businesses and identifying businesses with fantastic business models, because a company that can earn an extra 5 cents on every dollar it reinvests in itself come down to the business model. Not only the business model do we focus on, but also the market opportunities for growth. We're different in that we only have one fund, and so all of our efforts and energy goes into that one fund, and we aren't constrained by geography or industry. We look at anything and everything. It's kind of like an all-star hockey team. We pick all of our favorites from all these different areas and put them into one fund, a concentrated portfolio of 30 to 40 stocks. 3 years ago, we decided to start angel investing, leverage our combined decades of experience in researching publicly traded companies. Not only is it the business model and the markets that we research, but also the origin story. A lot of companies we invest in are founder-led, and so we have spent a lot of time researching those types of companies, and we parlayed into leveraging that expertise and experience, angel investing in B2B SaaS startups at the very earliest. We prefer to be as early as is possible. All investments that we personally have made have been valuations less than 5 million Canadian dollars. So that's where we want to be, but revenue-generating businesses, co-founder-led teams, one technical, non-technical, and it's the early days. It's exciting.
Thanks for that. So yeah, back to sort of the Silicon Valley perspective, at least on things. Looking at their first quarter report as sort of the state of the market, they take a survey of what's happening, sort of remarking that this is the largest correction we've seen since the dot-com bust. Finally, it seems through the data that they're seeing through a large portfolio of tech companies, there's some normalcy returning in respect. Money is moving, and so I'd love to get from each of you kind of what normalcy looks like in the work that you do and for your portfolios. But maybe just stepping back, macro perspective for a moment. So Emily, you invest in public equities through that part of your work in addition to your angel work. So at the biggest level, we're public markets are kind of pushing all-time highs again, and so what are you seeing there that's interesting, encouraging, problematic, and maybe how that relates to that, and right down to sort of small companies too. Is there anything in signals we can see in the public markets that help us around early stage investing?
Yeah, thanks, Steve. It's interesting how public and private markets interplay. So if you look at the last 35 years, the percentage of companies that outperformed the S&P 500, those that were in the S&P 500, was 49%. So about 50%. Makes sense. The S&P 500 is an index. It's an average. Approximately half of them outperformed, approximately half of them underperformed. But last year, less than 25% of stocks outperformed the S&P 500 index. So it was a year where the S&P 500 was up 24%, and most stocks were left behind. And that's exemplified by, at the end of the year last year, the Magnificent Seven stocks represented 28% of the index. And we've seen the same thing happen in private markets. So, you've got companies on this side of the spectrum where we hear about these down rounds that they're facing or needing bridge financing. And then on the other side, the 20%, I think approximately, of funding went to artificial intelligence startups in venture capital dollars last year. And so, and not only did the volume increase, but at premium valuations. So interesting, the mirroring that has occurred between public and private markets. I would say in terms of the going forward question, cautious optimism, these macroeconomic important things that we look at, inflation, interest rates, I think the worst of that is behind us. And that's good for a lot of these companies and industries that were left behind and didn't participate in the recovery last year. So that's exciting.
Okay, no, thank you. And so I'd love to get also your perspectives, maybe the seed to Series A stage, Rachel. What are we seeing? There's certainly have been some down rounds and whatnot, but the data indicates that's not leading to companies failing necessarily. It's just a recorrection across the board. So yeah, what's most topical with the founders you're speaking to?
So I think your explanation is spot on. I call it the have and the have-nots. So if you look at what happened last year, it was a very strong correction. But if you look at pre-seed and seed, and that's where we do the bulk of our business, valuations were actually trickling up. They were between 4 and 12% up at the pre-seed and seed level. But, there's a big but, about half as many deals were done. And so there's this huge bifurcation of the market where you're seeing a lot fewer deals getting done, but those that get done well, get done at decent valuation. So I think there is that force going on. I think there's also an element, to your point about down rounds, of just, recalibration of the industry. There were a lot of founders that raised in 2020, 2021 that were just way above their skis. And what you see is, mathematically, the bar is so much higher, the expectations, where their ARR needs to be. They just can't get from point A to point B with, it was so out of whack to where the market is today that they're either going to have to take a down round or shut down. And so I think what that's created is, a down round is fine. It's going to happen. There are a lot, it's not a death sentence for a business. There are businesses that will have to recalibrate, and it's a tough pill to swallow for investors and for founders, but it's the right thing to do for the business. And so, all that context has gone on last year. I think what you're seeing this year is a little bit of, I call it like the early green shoots. It's like if you look in the earth, there's like a little bit of green coming through. So I do see more VCs deploying capital. I think there is still a lot of dry powder, but I don't think it's going to be sort of the stampede of 2 years ago. I think it's going to be much more thoughtful. I think valuations are going to continue to sort of be steady, maybe go up a little bit. AI is the exception, right? I think AI is where there is huge amounts of opportunity, but there's also frothiness in the market. And so you really have to, and it's already starting to correct a little bit. I think that if you look 6 months ago, they were just sort of flying, and now we're like, well, how much are these companies really worth? How much is their competitive advantage really sustainable? Are the incumbents sort of have the distribution advantage and are the ones that are going to win? So it's just that there's a lot of forces happening right now.
Yeah, definitely want to get to AI. There's a lot, as you say, happening in and around that. But maybe Saanya, just love your perspective as sort of maybe the growth stage range. How are runways looking with companies? Are they feeling comfortable to get to where they need to? Whether that's IPO or what does that range of the market look like?
Yeah. I mean, markets are fundamentally cyclical, so I think it was expected that as soon interest rates went up, the public markets were hit. It trickled first to growth. All the exit multiples compressed around 22, and people just weren't underwriting deals the same way. And I think where we are today is, as you rightly pointed out, it's a tale of two cities. Anything that's AI related is continuing to see a lot of enthusiasm. And everything that does not have that AI angle is really struggling to articulate the value add in this world and how to justify the multiples. What we're seeing at growth is there is still a lot of bloat that hasn't worked its way out of the system. Because when when the market sold in 22, all of us kind of sat down and looked at all of our portfolio companies. And because we were just coming out of such an exuberant economic cycle, everyone who was doing even remotely well had raised a ton of capital at the top of the market at very high valuations and had 2 to 3 years of runway. So if you add 2 to 3 years to 2022, it's where we are today. So I think there's still a lot of companies that haven't had to make that forcing function decision yet that are going to be coming to market. And that's why we're also seeing a lot of M&A happen, where companies are selling themselves for tech, or maybe there's an acqui-hire situation. Companies are shutting down. So in terms of working through the last cycle, I don't think we're fully out of the woods yet, at least on the growth side. Obvious exception for anything AI related, where honestly, what is early and what is growth, the lines blur a lot. If you're raising a 200 million Series A, who's to say what that is? I think what is interesting to note is also how, like to your point about the IPO window, how that's going to be impacted by the fact that the US is going to head into a very volatile election season in the second half of this year. And we're already talking to a lot of companies that are trying not to go out to market in 2H of this year and trying to do it now, if at all. So those are kind of the things people are considering when making this decision.
Yeah, just a quick touch on that point, actually. How do you see that volatility perhaps playing out? Obviously, the election is coming, it's scheduled, it's on the calendar. But is it just companies not knowing which way the winds blow ultimately as to whether they're going to make investments in things? Was everyone just holding back until they know what the picture looks like? Is that sort of the main issue?
A little bit of that. You don't know how the public markets are going to trade because there's this impending thing. And the interesting thing is you can have an idea of who's going to win, but again, you won't know how the market's going to trade. Like when Trump won in 2016, everyone was like, oh, the market's going to tank. And it did, except there was massive whiplash the next day, and it was up and to the right. So the unpredictability of the market reaction to who wins is compounded by the unpredictability of who wins, and no one wants to touch any of that. So I think because public markets are going to get uncertain, growth markets are going to be looking at publics for what are exit multiples we're underwriting to. I think it's going to be, if you can avoid it, do avoid it. But I think there's always a big caveat for any funding discussions, which is if the numbers are speaking for themselves, everything else is noise. Like if you're at the cusp or this is a good investment, then everything comes into the picture. But if you're a great investment, people are going to be clamoring to put money in regardless of market cycle.
Mm-hmm. No, that makes sense. Well, let's hope after the election there's at least certainty as to who won this go around. So on the Uber ride over, I heard a song that went, Trump won and you know it, singing on it. That was the refrain. I'm like, this is so interesting. Anyways, to the AI question, love your relative perspectives on where the most interesting opportunities are. Is this focus on foundation models and companies? As some of the hyperscalers and big companies, obviously the Microsofts and Googles of the world, or application layer? Are you is it health tech? Is it what do you sort of high level? What are you seeing in AI? And then I've got some sort of follow-on questions as to how it's changing the market.
So, we focus on the early stage, and my feeling is that the underlying models, that's been going on for 10 years. That is not an early stage game. And so we tend to not focus on that. We're looking at the application layer. Now, my view is that ultimately every company is going to be an AI company in some shape or form, right? If you are building a company now, why wouldn't you apply, leverage the data, have the personalization, so I think that it's going to continue to evolve what we even talk about and define as an AI model. So I think number one. I think number two, I think there are a lot of founders that are underestimating just how quickly the incumbents are moving along on the AI, how quickly they're integrating it into their core products. And frankly, the incumbents do have an advantage because they have distribution. And they have vast amounts of data, which you need for AI. And so I think we look at it with a very tough lens. We absolutely think it's transformational, but we also think that think a lot about what are true competitive advantages, where are the moats, what are the opportunities that are really so specialized, so ownable that you can build startups that win.
Hello? Yeah. Couldn't agree more. I think AI is not a platform shift. It's more of a technological evolution. So incumbents that already control distribution have a lot of advantage because they have the customer already, and customer behavior is very hard to change. So if your Gmail becomes AI activated, that is going to be a much easier sell than, hey, net new, route your email to this new email server. So I think the fact that the trillion-dollar companies today are working with the agility of a startup tells you that they cannot be discounted, and they're really leading the charge when it comes to this adoption. So the question becomes where are the opportunities? What's also very interesting, to your point, every few weeks OpenAI comes out with a product announcement, and then people wear these T-shirts that are like, OpenAI killed my startup. It is very hard to be a founder right now because you have to be super adaptable, super resilient. The ground is changing beneath your feet every single day. I think the way we see it is the differentiation comes from the same thing it always has, which is what is your domain expertise and what is your customer focus. We do think there is some edge to building a thick wrapper around these technologies because increasingly it seems like foundational models are getting commoditized. And in a world where open source is also doing well enough, and you're going to come to a point where for most of the use cases, a lower cost application of an open source model is probably going to get you just as good a result. Then it's going to be about what are you powering with these foundation models. And that's where when you get into these gnarly verticals, when you get into supply chain optimization, you get into healthcare, you get into legal, you get into note-taking by doctors, when they're seeing patients, things like that, like picking an area of focus, building workflows that are very customized to that particular vertical will help you win the market. And then you have to find places that are sheltered from the Microsoft, the Apple, the Facebook, et cetera, as well. So it's finding the balance, but there's definitely places to innovate.
Yeah, I'd be curious, in terms of where these LLMs are being put to work, particularly when we look at software development, it seems it's going to radically reduce the cost of creating software. And so, largely you're investing in SaaS companies. There's some that suggest those companies will have less of a moat, and when the company starts doing good things, others are just going to jump on the bandwagon, and there'll be a lot more competition. So, as investors, how do you sort of see that? Is that a risk on the horizon of finding companies that really will do something unique enough? Maybe it's patented, maybe it's IP driven. I guess what are you looking for in terms of that? Perhaps risk. I guess. Go ahead, either of you.
I think it's with Shopify and drop shipping and all of these things, already the barriers to creating a D2C brand are so low. but we still see some standouts. Like, I think it's gonna, like, yes, the barriers to creation will erode, but then creativity will be at the surface and people will win by understanding their customer better than anyone. So I think we've seen the analogy play out in retail, and we're gonna definitely see it happen in software creation as well. But not everyone will know what to build. Not everyone will have the product eye. Interesting you say that. Actually, one of our portfolio companies is a company called Poolside, which is started by the former CTO of GitHub, that is essentially trying to democratize software in a way where everyone is a creator and a developer. And I'm very excited for that world because more people building more software can only mean good things. So
that's great. I feel like we're poolside here, and that founder actually is based in Vancouver with the lights and playing on your skin there. We've got the fellow I guess he moved from GitHub to Vancouver Island, so we've been meaning to connect with him. If you love to put us in touch, I'd love to meet him. But yeah, we're getting close to the end of this. I'd love any sort of thoughts you have to share with founders, maybe advice. Emily, I don't know if you know, we talked about this before. Anything to share as folks are going out to raise money these days? Just tips to have in mind. So you're getting often those early stage first money raising pitches. Any sort of thoughts for those founders doing that?
Sure. I guess I would say that venture capital has come a long way over the past 70 years, since the 70s when the iconic legends like Sequoia or Kleiner Perkins were formed. It was just a cottage industry back then, and it's come to the point today where we're in democratization, really, which is why someone like myself, and I would encourage others in the room to consider being an angel investor, why that exists, that opportunity exists these days. And what has also occurred with that has become a shift in the balance of power toward founders, which is why you saw in 2005 Y Combinator, and since then other accelerators and incubators start up to try to encourage founders to consider them as their investor partners. So you're in a position to really be selective about who it is that you want to partner with as that first financial partner. And it really is a marriage. And in angel investing, we really love it because you have the chance to get to know the founders, so people that you want to go grab a beer with. And I would say for everyone else in the room that isn't a founder and is considering angel investing, you absolutely should at some point in your life, because it's just an incredible opportunity to really be at the early stages. The growth is incredible, milestones are incredible, and you're alongside these wonderful people. It's just a real life value add to have these incredible, bright-eyed, bushy-tailed individuals in your life, and be a small part of their journey. And then for founders, I would just say be humble, be absolutely hyper-focused, be prepared to have hard-hitting questions, and don't let the ego be damaged through that. Just be willing to accept that maybe there are holes that could be uncovered. So, yeah.
Thanks very much. And to the panel, we had to let the next speakers up on here, but I really enjoyed this conversation. And yeah, we'll catch up more after.
Thank you.